Hello and welcome into the KE Report. Shad and Corey here as your host. And today we're talking with our friend and colleague Nick Hodge. Nick is the co-owner of Digest Publishing and editor of Foundational Profits and Hodge Family Office. And Nick, it's always great to get you on the show because we end up diving into all the different macro themes on your radar, but also the micro themes within the resource investing universe that we all swim in. And I guess let's just kick it off in a general sense that we talked a little over a month ago on May 21st, and a lot of the themes we were discussing that the world was not going to end, that the US was not sliding into a recession or a depression, that the stock market was going to recover, that we still were going to see strength in the commodity sector, and we were still going to see inflation ticking up. A lot of those same themes have stayed with us. So I guess let's just start there, bridging the gap from our last conversation into this one. Nick, what's on your radar now as far as the macro and the major currents you're seeing in the markets?
Sure. Shad, Corey, thanks for having me. Always a pleasure to be here. Yeah, you said it well. Back in May, people still had a lot of consternation about what was going on, right? I mean, in March and April, the broader markets, the S&P fell off a cliff because of consternation about tariffs and things that were happening in the political and geopolitical realm. And then we had a bond scare, right? I remember talk of the bond vigilantes, the 10-year was going to go to 5% and the world was going to end. And I was sort of telling you guys, I think the S&P wants to rebound. I don't see recession. I see getting back to growth and I see reinflation, which can be okay in market and commodity terms as long as there's growth to back up that inflation. And that's sort of exactly what's happened over the past month and a week since we've last spoken. You had a negative GDP print in Q1 for the US, negative 2%, we now know on the second print. But the current quarter that we're in, which is about to end here in 5 days, the second quarter will likely be much higher than that. It'll be a positive number. It'll be between 1.5 and 2%. And that's why you've got the bounce back that you had in the S&P, not quite back to record highs at 6150 or so, but the S&P did bounce all the way back to 6,000 and remains sort of bullish. Inflation has ticked up, right? It sort of bottomed on a monthly basis in April at 2.3%, ticked up to 2.35 or 2.4% in May, and you'll likely see a higher print than that in June. And we can get into the reasons why in terms of rising commodity prices, copper prices, natural gas prices, oil prices, but in a very real way where we've gotten back to growth and inflation. Now, at least on the growth and S&P side, levels out here in the next sort of month and a half, 2 months. The markets are forward looking, and it's very easy to accelerate from a negative GDP number and a negative S&P in March and April to a positive number, which is what we've seen over the past month or month and a half. But the comps then get harder, right? Because if we print 1.5% GDP growth in the second quarter, it'll likely be close to that or slightly higher in the third quarter. And so the market won't be pricing in as fast of a rate of change of growth. So, I see a little bit of broad market headwinds materializing in July and August, and not just because of the chart and not just because of growth and inflation. You've got a couple of, monetary policy driven events that are going to happen in July as well. We'll get a pausing or an ending of the tariff pause that, was enacted in April that ends on July 8th. You'll have the Congress and Senate, the Senate, you sort of rectifying the big tax bill, right? That's very un-Doge-like. That's going to add to the money supply. That's going to add to the debt. That's going to add to the deficit. That's going to give the rich the tax breaks and potentially fan inflation. And then, in the middle of July, you'll get a CPI print, which I just told you is going to be higher. And so you'll likely get a Mr. Powell saying that, we're still not going to cut rates. And so I think you'll see a bit of volatility in July and August as those events play out. And I intend on buying that dip, both in broad markets and commodities, to position for a late Q3 and Q4 when I expect this geopolitical turmoil wars get behind us, those policy events get behind us, and then we get back to growth in late Q3 and Q4. So a lot there to unpack. As always, I'm happy to go anywhere you want in terms of commodities or further macro stuff.
Let's just stick with the tariffs because that is coming up. Everyone has recently, understandably so, gotten pretty distracted by the geopolitical news in the Middle East and the war and then pullback on war. But with these tariffs coming up, look, Trump made a big splash in the markets back on Liberation Day and then quickly reversed those tariffs. And this whole theme of the taco trade, Trump always chickens out, which is essentially a buy the dip if the markets react to any tariff news. Do you find that some of this tariff news, yes, it's been on everyone's kind of back burner because we're waiting for the end of this 90-day pause, but it does seem like Trump kind of chickens out. So could that just be another buying opportunity if he does, let's say, issue some tariffs and then everyone just assumes he's going to pull back on them right away?
Yeah, look, he was out of office for 4 years. I think people got complacent with Sleepy Joe and they forgot how erratic and boisterous and what the modus operandi of Mr. Trump was. Yeah, he rattles a saber, he shakes his hands, he tries to move markets over the weekend with tweets or Truth Social posts. And so yeah, I think that the market in general, people, investors, the general public are getting reacquainted with the way he operates. And so you're right, Corey. I've seen the taco trade out of the corner of my eye, but I haven't spent a lot of time looking at it. Yeah, I agree that it's going to be sort of a non-event. And if anything happens in the markets that pushes the S&P down, either for the reasons I outlined a second ago with, the rate of change of growth slowing down after reaccelerating here in Q2. If tariffs cause any volatility in the market, those are dips to be bought. And you can do that in a variety of ways, depending on, what you're trying to position for. So I'm not a big tech guy, but like I'll start buying the Qs. I put out a buy alert on the Qs in my May issue of my macro letter, not at current prices, but at prices below where we're trading to get to use that volatility that I see coming in July and August to position. Even cryptocurrencies, right? I've been looking at and in fact issued a buy order on again at a lower price than they're trading now, but just to use these events that I just laid out for you as buying opportunities in the market because, well, as you say, Trump always chickens out or the half-life of whatever he's saying or doing seems to shorten, right? Almost like the boy who cried wolf in some respects, right? Like the village starts to wise up. So maybe one day the wolf will be at the door, but I don't see it right now in terms of tariffs, in terms of geopolitics, or in terms of the bond market, frankly, which yields have turned around and gone the other way after everybody was worried about these bond vigilantes a year ago, and we had talk of sovereign debt crisis. So yeah, believe me, I understand the problems with the debt and the deficit, and I see the dollar getting weaker, down around 97, but I don't think that's anything to wring your hands about too much, at least in the year 2025. They're pretty good at kicking the can down the road. So take the tariff talk with a grain of salt and buy the dip, I would say, in the broad equities and some of those sectors that were ripping in sort of, 2022, 23, 24. You'll get back to some of these trades where you see, the Nvidias or the drone stocks or whatever. I mean, just look at some of the buoyancy that have been even in the nuclear stocks that you were asking me about last time we talked, Corey, like Oklo and NuScale and stuff like that. I mean, these stocks want to go up, I think, and I think the market learned its lesson about the tariff talk and the Rose Garden ceremony in April, not to get too caught up in it.
Yeah, some good points, Nick. And I think that the market does have a tendency to overreact initially, but then to your point, it gets a smaller and smaller half-life on future issues like that. We've seen that with Fed policy as it was implemented, whether it was the hikes or the cuts. We've seen the same thing happen with some of the geopolitical stirrings where it's initially a big reaction, then it gradually fades back down. And the same thing's starting to happen with the tariffs where people get fatigued on that idea. And so you don't see as big of gyrations. But we have seen, if we switch it over to the commodity sector, maybe just a quick thoughts on oil and nat gas. You brought up their higher prices. How does that play into inflation? Are you looking at all on oil and gas as another sector to invest in? Do you think this is just a geopolitical reaction, or is there more to it than that?
No, there's more to it than that. let me start with industrials for a second. Like if you look at the 11 sectors of the S&P for the year, as we're halfway through it, you'll see that industrials are far and away leading the pack. That to me signals that the economy is okay and that there's some strength there. So that spills over into oil and gas, which you're asking about. Those tend to, strengthen up when the economy is strengthening up. And I started to see that back in May. I actually put out a buy alert on XOP, which is the exploration and production subsector of the energy sector of the S&P. I did that in early May, and I did something that I'm trying to get away from doing or trying to get better at. I put a buy limit on it that was below where it was trading at the time. This is before. This is the first week of May. This is before, bombing of nuclear facilities, Israel, Iran, all that sort of stuff. And I didn't get my price, and the next week I learned why, right? The market was starting to price in the spike in oil that was coming from, oh gosh, do I have a chart up here? Yeah, I do. From the 55, 56, it was trading in May to it ended up going to $76 a barrel inside of a month or a month and a week as those bombings escalated and as the US got involved. So that's the short-term catalyst. I didn't get my price on XOP. And at the same time, you asked about gas. So let me check that down for you. That was at $3 at the end of April to start May. It ended up going up by more than a third. It got to over $4 in the past month. So yes, both those things may have been spurred on by, what the market sniffed out coming in the Middle East, but I don't think they retrace all the way down to where they were back in May. So a couple of points on that. One, it speaks to the reinflation that I was talking about, and natural gas and WTI crude, pretty large components in the CPI calculation. A lot of people drive cars still, as I recall. And it also speaks to a strong economy in the second half. So, I'm going to buy these oil and gas stocks up here. I'm giving a macro presentation here in about an hour and a half. I'll raise that price target or that buy price that I had put on the XOP in early May. And we'll use this pullback here because gas and oil have pulled back in the past week. It was sort of a sell the news, right? We dropped the bombs. What was that, last weekend? And then in the past couple of days, oil and gas has come down. If I said that oil hit $76 a few days ago on I don't know, the 21st, the 22nd, it's already down to $65. So I am deploying capital in the oil and gas sector in the US. And so what else did I want to talk about? I might just pivot to copper if that's okay, because that's another pretty large reinflation trade. And it's one of the commodities that we were talking about last time we spoke. I was saying that copper had been closer to 4 recently than 5, but was still in a large sort of secular bull market, I think, that started in 2020. And if you look at a copper chart, that's exactly right. Like, it looks really good. It's channeling up. It's putting in a bullish flag. The channel is up and to the right, and the copper that was $4 a month or two ago is now $4.90, right? Having added 20 or 25% in a month. And so this is what I mean when I say that reinflation is on. And I've spoken to you guys in the past about FCX. Freeport was the way I was buying copper. And so in fact, last time we spoke, I said that trade hadn't started to work yet, but now it is working. FCX has done well over the past month since we've spoken. There's obviously sector tailwinds behind copper that are different for oil, but from a high level view, from a macro view, talking about these big companies and ETFs, it's definitely a reinflation trade that is on right now.
Nick, I want to go back to the oil market because, look, oil did spike on the back of the US, especially entering the war and Iran and Israel bombing each other. But before that, it had broken down out of its multi-year trading range. And what I'm hearing from some of the oil analysts, the ones that maybe aren't always leaning on the bullish side, is that it's a pretty balanced market. And the US rig count has been going down. That hasn't really impacted price because, again, we had a breakdown in the oil price and it has been trending lower over the last few years. So to me, it surprised me a little bit that you're on the bullish camp for oil because of that recent breakdown. Do you think that's simply that move down to the $56 range in April and May simply just a false breakdown then?
Look, for the rig count, I think that that's probably a leading indicator, and you might have to parse out markets a little bit. So you've heard talk about the Strait of Hormuz, obviously, in the past couple of weeks. And the U.S. has, in the past, I don't know, 10 or 15 years, really ramped up its oil production in terms of shale and multilateral wells, et cetera. And you're correct, Corey. I read some of those reports as well, calling for a balanced oil market. I think you might get a little softness in production in shale. I think that, some of those fields are getting older and not as productive. And I'm looking more at Gulf of America or Gulf of Mexico production to increase, and have been looking at some of the companies that are doing that. And then, you could get sort of a bifurcated market, right? Oil is this fungible commodity that is, my oil here in Spokane is the same as oil around the world. It's fungible in that way. But, think back just a couple of months to when the tariff talk started with copper, and we got a bifurcation of the price on the COMEX versus the LME as people rushed to buy, quote unquote, non-tariff copper, or to get copper into the US via the COMEX and out of Europe and the eastern part of the world, out of the London exchange, right? Because of the tariffs that were coming. I think you have a similar situation currently right now in oil, right? With a premium being placed on WTI and the companies that can produce that versus the riskier Brent or heavier crude and some of the oil that has to pass through that Strait of Hormuz there. And so that's why I talk about the XOP, right? I'm talking about these oil and production assets in the United States. And then I think the growth is going to surprise people. So, I think you'll see 1.5% US GDP for the current quarter, and about the same in the third quarter. And then I think you'll get something bigger than that in the fourth quarter. As I said earlier, as these tariff talks get in our rear view, as Trump settles into his second term, and you get sort of a 2, 3, 4% GDP in the US in Q4. So I don't think it's a false breakdown. I think, like you said, oil's been trending down for, as I look at the chart here, since 2022, when it hit $120 a barrel, all the way until last month or April, when it was at just below $60 a barrel. So I can appreciate the current balanced market, but when I look at even the earnings of some of these oil and gas stocks in Q1 were starting to improve. And when I look at more anecdotal things like the percentage of the S&P that the XLE is, it used to be 10 to 15% of the S&P, oil and gas did back before the shale ramp up in the early 2000s, and energy currently only comprises something like 3% of the S&P. I think it's going to revert to some sort of mean where people, Americans, institutions are going to want to own more energy stocks going forward, and that's why I'm sort of bullish on XOP from a macro standpoint.
Well, Nick, just sticking with the energy theme, I think another market we need to discuss is uranium and nuclear power. Since we've talked, we've had some pretty interesting developments. We've had Trump come out, the administration, with 4 different executive orders focused around the nuclear industry, focused around the fuel cycle for nuclear power, small modular reactors, getting domestic production of uranium going again. We've seen just this week that the governor of New York plans to build one of the first U.S. nuclear power plants in a generation. We've seen a lot of tailwinds as far as the supply constraints from the mining companies. How are you looking at nuclear power? How are you looking at uranium?
Still bullish, and it was getting bullish on it last time we spoke. Was pointing to it as one of the commodities that could potentially break out as it approached $70, and now has gotten back over $70. You did a good job there, Shad, of recapping or recounting the macro news items that have happened over the past month. You missed 2. You missed Meta signing a new agreement with Constellation to power their data center and AI ambitions. And that's not the first company that signed with Constellation to do so. Microsoft did so. I don't know if it was earlier this year or last year, but to buy power and restart 3 Mile Island. So two big, and in fact, two of the biggest tech companies in the world signing up with a nuclear utility to get that clean energy to power their data centers. You actually might have missed three. You had the Air Force say that they're going to start using small modular reactors to power bases, starting with one in Fairbanks, Alaska, where you likely can't use solar panels, for example. And the big one was the World Bank saying that they were going to start funding nuclear energy as part of clean energy solution. They had a ban on funding nuclear energy projects, and so lots of things to talk about. Even in the UK, right? They're gonna build a new plant at Hinkley was in the news in recent days, and I think EDF in France is going to help finance that. So lots of bullish macro markers and news in the uranium space. The price has firmed up. Still haven't seen the utilities come back into the market in a real way, and I think that's the next catalyst for higher prices. But at this point, I think we've had a sea change or a paradigm shift in the way nuclear energy is viewed and the way that institutions are, turning to embrace it, and also in the public sentiment towards it, not just in Japan, which had Fukushima in 2011, but if you go to Pew Research and look up energy sentiment in the U.S., you'll see that a growing proportion of Americans are now in favor of a nuclear expansion, and so getting a little bit more esoteric or philosophical for a second, for me, the clean energy solution, a large part of it has always been nuclear. I've been a proponent for the past 10 years, and it's been a sort of a tough grind, right? There was still pushback. You had Germany that abandoned their plants. You still have Spain, in fact, talking about shutting down their plants, which is likely not a wise idea given the blackout that they just experienced a couple of months ago that everyone has probably already memory hold. But I think we're on just a new nuclear moment, right? Sort of like the 1940s and 50s, where we're really going to embrace this new technology, and it's going to unlock sort of the next phase of humanity, right? I just said I was going to get philosophical, right? And in my younger days, when I was first getting into the energy space, I spent a lot of time writing about previous energy transitions, right? From wood to whale oil to coal to oil, and the booms and benefits to society that came along with those. I think you're truly on the cusp of the next age of cheap, clean energy here, as evidenced by these catalysts that are lining up, and by the willingness of the biggest tech companies in the world and the biggest militaries and most well-funded tech companies and militaries of the world to embrace it. These technologies are only improving. We're breaking ground in Idaho for small modular reactor tests. Bill Gates is getting increasingly vocal. They're raising money. That's another thing worth mentioning. Like there was a big Financial Times article a couple of weeks ago about how Oklo and TerraPower had just raised $1 billion, right? That's real money in the real market, not just in the niche uranium market. And so the last point there is that, I mean, you had a run in the uranium stocks in sort of the first phase of this bull market, 2016 to 2020, 2021. But it's been a grind for the past year and a half, and we've seen these other stocks run. Corey, you were asking me last month, and I mentioned earlier Oklo and SMR and NNE, the nano one, and even LEU and some of these other stocks that own the technology, that own the engines that are going to burn the fuel. And the analogy I've been making, or the comparison I've been making, is to that last energy transition. I was saying that I was writing an editorial this week that horses looked kind of silly in the street when they started getting parked next to Model Ts and such, right? And I'm sure you've seen those pictures on the internet of those years in the transition to internal combustion engines. Henry Ford did great on that. He died with a net worth close to $200 billion in modern monetary terms. But the person that got the richest was the guys who owned the fuel assets, right? The oil assets. John D. Rockefeller was became the richest man in the world, twice as rich as Ford. And so that's sort of the comparison I'm making now. Like Oklo and NewScale, yeah, great. That's sort of like the Ford. That's the engine that's going to burn the fuel. But the fuel makers still need to run. Like that fuel still needs to be bought. We still have a supply demand curve going forward that is out of balance, and you need to have a higher uranium price to rectify that. And so bullish on uranium, right? Took the opportunity in recent months to add more URNJ, and then am involved in some smaller companies and looking for more. Like you got a sort of not a new class, but kind of a new class, right? You mentioned the permitting of Anfield's Velvet Wood project in Utah that's been expedited. You got U.S. companies starting to produce. You've got Denison trying to get in production in the next year and a half or so, and you got companies listing on the big board like ISO Energy and things, for example. So, and then you've got new listings like Homeland Uranium I've been looking at. So lots to like in the uranium space, and I continue to be a uranium bull.
Okay, yeah, I was going to follow up with you on that because we've seen the nuclear stocks. They've drastically outperformed the uranium stocks. A lot of those names that you mentioned they're close to all-time highs. They've just exploded. Well, the uranium stocks have done well, but man, those charts on any of those nuclear stocks, they are absolutely to the moon. I guess maybe the uranium miners play catch up, but how do you go about selecting uranium miners then? I know you like to play the ETFs, but any company specific names or fundamentals that you look for? Because it's not an overly large space in the uranium space of equities.
No, I do individual companies, and we've talked a lot about this. So, and I mentioned a couple of them there. Like I've been doing more due diligence on ISO Energy. I like that they have a big board listing in the U.S. I like that they just raised or are in the process of raising $50 million that sort of caused the stock to sell off. That means they're going to be well funded. They're in a good jurisdiction, so have been looking at that. And then one more thing, I look first at those big board listings, right? And I probably given you this answer 5 times or more at this point. I own Denison, I own Energy Fuels because I believe they're going to be the first go-to names. Like you said, the sector is not that big, and I mean you only got a couple to choose from. So with Energy Fuels, you get the rare earth component, obviously, which we haven't mentioned, but has been in the news in a very real way with the banning of Chinese exports of magnets and things like that. And I should tell you that Cotec, which I've been talking to you about, the rare earth recycling company, hit all-time highs in the past month since the last time we spoke. But back to nuclear. So yeah, I think those Denison's, UEC's, Energy Fuels are going to be the go-to names when the broader money starts coming into uranium, and you'll likely need to see some more deals or announcements to make that happen. And then on the smaller end of the spectrum, it's this what it always is for me on the smaller end of the spectrum. It's share structure, it's people, and it's jurisdiction. So not a lot out there, as you said, probably, the company I've been eyeing the most is Homeland Uranium, which I just mentioned, and it's a fairly recent listing. I think they did $16 million as part of the deal to get that company trading, so they don't need to raise money as well. They have uranium pounds in the ground in western Colorado. So a bit of a head start, right? Not looking to find something like most of these companies, or maybe most is not fair, but many or some of these companies, JVing properties and drilling moose pasture in Saskatchewan. Homeland is in the United States. It's appropriately named given the executive orders that Shad was just mentioning, and it has a head start with pounds in the ground, and it doesn't need to raise money. So those are the things I sort of look at when I'm looking at companies. And gosh, if you just own a basket of those 3 or 4 names, then you're doing pretty good in the uranium space, I'd say.
Well, I think we'll wrap it up there for today, Nick. But it's a lot going on in the energy sector, whether it's the oil and gas side of things, copper, or the nuclear stocks and the uranium stocks. And hey, we even saw 2 different M&A deals in the smaller junior uranium stocks just this week. So definitely the interest is picking up, as are the stock prices, as are the ETF prices. So a lot going on in the energy side of things in the commodity sector. And I like your big picture outlook on the rest of this year and how things may unfold through the summer, but then going into the fall with the broad markets and how you're going to be widening the net, so to speak. So always great having you on the show, Nick. And if people want to get more information from Nick and his partner Gerardo, definitely click on the link down below in the show notes. It takes you over to Digest Publishing, where you can see their full suite of offerings. And Nick, as always, looking forward to our next conversation.
Me too. Thanks, guys.